Hello and welcome to the second workshop in building a strong financial foundation educational program. In this second workshop, we will be discussing building a strong financial foundation with proper protection. I'm Rochelle Delia, co-founder of Housing Joint Venture, and super excited to share this information with you all today. Feel free, if you have any questions, do hop in the forums. We'd be happy to answer any questions and really discuss this even further. Alrighty, let's jump right in. All right, so in this workshop, here's what we're going to discuss. First and foremost, how to have a strong protection plan. The next is the relationship between building wealth and fulfilling your responsibilities. Do I need life insurance? And if so, how much? After all, when we're talking about building a strong financial foundation, protection is really important, and we would be remiss if we overlooked it. We're going to discuss the different types of life insurance, as well as how to choose the most suitable plan for your family. So let's talk about it. When we talk about this foundation, what are the challenges that you have? First off, you want to protect your family for your life, your health, and your disability. In our roadmap, you'll see that this is really about protecting your income, your today. So, additionally, we want to reduce our liabilities so we can get out of debt sooner. Because let's be honest, we're dealing with constant changes in our job, our career, and our business. Okay? And of course, we're also faced with living a long life without adequate income. So it's wonderful that advances in healthcare have allowed us to extend the livelihood and the lifespan of everyone. But if you live longer but you don't have more savings, then it kind of puts you in a catch-22 because you're happy that you're living longer, but if you don't have adequate income, then what kind of life is that really? So here we go. So we start out with proper protection as our foundation. Then we focus on debt management, building our emergency fund, and then at the top of this financial pyramid, investing. So just like building a house, you build it from the ground up. Okay? Because honestly, without a strong foundation, everything you have may not last. What do you mean? I want to invest in real estate. I want to do all these fancy things. That's great. But honestly, if you don't mitigate risk in terms of having proper insurance and protection, then your income right now, you're not even able to maintain that. Let's do something extra like building wealth and saving for college and making sure your retirement is there. So really and truly, you have to protect your downside risk. It's all about how can I make sure that my plan doesn't go bust, okay? And no matter what happens, I need to put some guardrails in place to make sure it happens. That's what protection is all about. After that, I can knock down my debt so I can be leaner, faster, stronger. Finally, our emergency fund. That's because hiccups happen along the way. So it may not be a complete and total derailment, like passing away prematurely or becoming disabled, but having a family member get sick and you need to fly across country, or getting into a car accident where you need to do an emergency repair, even replacing a refrigerator. Those are emergencies, and so they won't derail our entire life, but they can obviously cause some uncomfortable months ahead. So that's why having protection is more important than an emergency fund. And then finally, we can get up to investing. Investing is stocks, bonds, mutual funds, real estate, CDs, all the nice fancy stuff that we like to talk about. And obviously, we have a lot of content here on Housing Joint Venture about it. But until we get this foundation in place, it would be inappropriate for us to talk about those things without making sure that you have your bases in order before we start swinging for the fences. That's all. All right, so here's the X curve. And if you haven't seen this before, essentially, when you're younger, you're on the left-hand side, and as you get older, you go to the right. So left to right, this is a concept of time, all right? So let's start on the left side. So when you're a young person, let's say in your late 20s to 40s, you're really focused on taking care of your family, okay? So you're generally less secure because you have a lot of responsibilities. You may have children, you may have student loans to pay off, your parents are aging, so there's just a lot of responsibility on you. And at this time, as you can see in the black curve, you have a lot of responsibility, and it's stressful because, as you can see from the blue curve, your wealth is low, okay? You just don't have any money to deal with all these problems, all these issues. But as you get older, time goes on, and you're able to build wealth over time. So over time, you become more secure. Why is that? Well, you have decreasing responsibilities as your children get older, as your parents, pass on. You no longer have those financial responsibilities associated with them. So therefore, you're able to use your money towards yourself. Okay, so you become more financially secure as those responsibilities wane. So as you're older, you're able to start taking care of your future because your family responsibilities are less. I do want to take a moment to mention, if you do have a copy of the workbook, up in the upper right-hand corner, you'll see the page that we're on, so you can follow along with the workbook should you so have it. So again, this responsibility curve. So in the beginning, like when you're younger, you have children, you have mortgage, you have to save for retirement, you have to save for their education, children's education, and you have debts as well. So you start out with high responsibility, but as time goes on, that responsibility wanes, right? So you have less savings, but high responsibility. But as you get older, that responsibility goes away. Again, as children grow up and get out of the house, as parents pass on, as older adults pass on, that responsibility is no longer on your plate. The wealth curve, unfortunately, goes in the opposite way. It's either you have time or money, right? So when you're younger, you have a lot of time, but not a lot of money. But as you get older, you have lots of money, but may not have as much time anymore. So again, the wealth curve is opposite to the responsibility curve. So you try to build wealth as you are younger. You start to save and invest, right? And as time goes on, you must accumulate wealth in order to retire. So you have more wealth and less responsibility as you get older. So really and truly, what we need to do is to bridge that gap. And so the way you bridge that gap is through life insurance. Okay? So you get enough life insurance protection when you're older, and you can reduce the protection need when you build enough wealth, once you have that as cold hard cash as you get older. Right? So the entire purpose of life insurance is to generate cash. That's all it does. It creates cash in a situation. And so we need to bridge the gap between when we're younger and high responsibility but low wealth, until when we get older and we have all the money and we're living in a lap of luxury, then we don't have as much need for life insurance anymore. Unless, of course, we want to leave more assets to our family than we've been able to accumulate in our own lifespan. And there's nothing wrong with that. Okay, so I'm going to read to you this passage about your life insurance policy. For me, it was actually very moving, and hopefully you'll find it as well. Hello, I'm your life insurance policy. You and I have similar purposes in this world. It's your job to provide food, clothing, shelter, schooling, medicine, and all the other things for your loved ones. You do this while I lie in your safe deposit box. I have faith and trust in you. Out of your earnings will come the cost of my upkeep. And at times I may appear insignificant to you, but someday, and who knows when that is, you and I will change places. When you are laid to rest, I will come alive and do your job. I may provide food, clothing, shelter, schooling, medicine, and do other things for your family that they'll continue to need, just as you're doing now. When your work and labor are done, mine will begin. Through me, your hands can carry on. Whenever you feel the price you're paying for my upkeep is burdensome, remember that I can do more for you and your family than you will ever do for me. If you do your part, I will do mine. Sincerely yours, your life insurance policy. Wow, it's so true. You know, when someone that you love is laid to rest, not only are you grieving, but you also have the financial responsibilities of having to deal with the realities of the loss of their income, and having to move most likely very quickly to attend to their final needs in the course of 2 weeks. So having something like a life insurance policy there and readily available to take care of those financial needs in the time of loss is really powerful. It really, really is. So here comes a question. So how do you buy something when you don't know how much you need? Well, we have an easy method, and it's called the dime method. So it allows you to calculate how much life insurance protection your family needs. So here's what you do. You tally up your debts. You take your income and multiply it by 10. You take your mortgage balance, if you have one, and any educational expenses if you're planning to pay for those for any loved ones. That total is how you determine your life insurance needs. So what do you mean by that? Well, in the case of your untimely death, or even if it is expected, you still will have outstanding debts to pay if you're not debt free. So someone will have to pay for those. So your life insurance policy can pay those off if you have not. Okay? Additionally, let's say you're a breadwinner for your family and you have small children. If you multiply your annual income by 10, that will allow you to be able to provide your income for 10 years after your passing. Wow, that's amazing. Okay? So you pass away today and you're able to provide the income for your family for 10 years. 10 years is a good amount of time to be able to have a plan. At that point, they can determine if they want to stay in the house or not, if they want to stay in the same city or not. At that point, small children become older children. It just allows that transition to not be so harsh and abrupt. I can tell you, even in my own personal experience, losing a parent, even as an adult, having 10 years worth of income would be so amazing right now because it would just, again, lessen that burden. Mortgage. Let's say you have an outstanding mortgage. Then you obviously want to pay that off for your spouse or your family members. Again, this is all about reducing that burden so that they don't take 15 steps back because someone that they love passed away. You want to propel them to be able to maintain the same lifestyle, if not even improve it. And then finally, we include educational expenses. Oftentimes, we want to pay for college for a loved one, private schooling, things like that. So educational expenses is very important to include in your life insurance planning needs. And you want to do this for both you and a spouse or a second parent or anyone else that would be financially responsible for the ones that you love. Again, the only reason to buy life insurance is to have enough coverage for the potential loss. It's like if you have a $500,000 house, you wouldn't buy $100,000 worth of coverage, or $10,000 worth of coverage for a $50,000 car. It's the same thing. We have insurance for our iPhones, for our cell phones, for all these things, but we don't have insurance for the most important part of us, which is our lives. There's nothing more important than a person's life, okay? And even more so, well, not more so, but in addition to that, is the income and earning potential that person has and the income they're able to provide for their loved ones. So if that's lost, if you're not able to be that productive contributor to your family, what are they supposed to do without you? And the last thing you want is a home to be foreclosed on or children to have to move. Even if you're just sending some money to your kid's sister or to your parents, where's that money going to come from if you're not there to provide it? Like these are real. Like this is adulting. So again, why would you have a $100,000 life insurance policy when your need is $500,000? Okay, and it can be surprising when you realize how much life insurance you actually need. But when you think about your family, and the ones that you love, you don't want to be undervalued. You don't want to be undercapitalized. Everything costs more than you think. So here we go. Here's how to buy life insurance. Life insurance is priced by what we call COI, or cost of insurance, and it's priced per $1,000. It's priced based on the age of the person at the time of issue. So what that means is if you are currently 30 years old, there will never be a less expensive time to buy life insurance because as you get older, the cost of insurance will increase as well. So here's what we're going to discuss. So if you are, for the purposes of this example, if you're age 35, let's say that it costs $1 per $1,000 of insurance. If you wait till you're 10 more years to your age 45, it's going to cost $3 for every $1,000 worth of insurance. Age 60, $8, and age 75, $25. So that's why it's so expensive to buy life insurance later in life. It's actually more cost effective to purchase insurance life insurance, specifically when you're younger, because it's denominated based on that younger age. 35-year-olds don't typically die, so therefore it's very inexpensive to buy it then. If you wait, then the longer you live, the longer, the higher the likelihood is you're closer to, let's say, kicking the bucket. So your cost of insurance is going to increase. Okay, so here's what we do. So in addition to your age, it's life insurance. So it's based on how likely you are to pass away. So the better health you're in, the less expensive your costs are going to be. So in order to get life insurance, the first things first, you have to qualify. So you want to be in good health. Doesn't mean that you can't get life insurance if you're not in good health, but just be aware that your cost of insurance will be more expensive than someone who is in good health. Okay? Your insurance rates are based on height, weight, health issues, past or present, any medications that you happen to be on, use of tobacco, family history, driving record, criminal record. Yeah, criminal record comes in there, right? So if you've been caught up with some stuff, your cost of insurance may be a little bit more, as well as any high-risk activities. So, if you like auto racing, scuba diving, mountain climbing, those are higher risk activities. So your cost of insurance could be, a bit higher, right? So before you take up any of those activities, you might want to make sure you have life insurance in place first before you even start getting curious about that sort of thing. All right. So the fee that you pay for life insurance is called your premium. So again, the whole purpose of life insurance is to create liquidity. It creates cash. So one way to think about it is you're spending pennies to purchase dollars. You're literally buying money at a discounted rate. Okay? So the premium you pay determines how much that discount rate is going to be for those dollars. And those are rated based on what we call rate classes. Okay? So the preferred elite class is the best one. Those are people that are in optimal health. Okay? These are your Olympic athletes, your long distance runners. These guys and ladies, they are the bee's knees. Okay? They are in optimal health. Preferred is healthy. If you're a healthy adult, most likely you can get preferred rating. Standard is for people that have minor health issues. So let's say you might have a little high blood pressure, okay? You might have high cholesterol. It's maybe elevated, but not like high enough for you to need medication. Something like that, that would be standard. So not too good, not too bad, okay? Then we have smoking rates. So in today's, at the time of this recording, we know that smoking is significantly detrimental to your life expectancy. It can lead to lung cancer and cut your life short. So because of that, smokers and non-smokers are rated differently. If you're a smoker, you are most likely to pass away prematurely. So because of that, if you are a smoker, then your rate is more expensive. So same thing, there's preferred smoker and just like average, potbelly smoker, okay? So a preferred smoker, their rates are 2 times the above rate. So it calls the premiums for a preferred smoker are 2 times that of a standard rated person, a standard non-smoking person, okay? A smoker who is just normal, not in, they don't work out, but they do smoke, they would be rated at 3 times the standard rate, okay? And if you have more severe histories, let's say like a history of depression or some other health events, then that's what we call table rated. And table rated persons can be anywhere between 25 and 500% more. So as you can see, it's very advantageous to get life insurance the younger you are before you have any health concerns that may put you into some of these other rate classes. So there is certainly a timeline of insurability, and if you have one or more of these health issues, then at a certain point you may not become insurable anymore. So you want the best day to get life insurance is today. Well, actually, yesterday would have been better, but today is good too. So are you still insurable? Are you able to still qualify for protection? If so, it's something to look into very quickly. So let's talk about the different types of life insurance, because all life insurance is not created equal. Okay? So let's go over a review. The first one is term life. So just like it sounds, term life insurance is for a specific amount of time. It is for a term. Okay? And it is kind of like renting. Okay? Like I rent an apartment for a year and I get to use it for that year. But when I leave, I haven't built any equity. I just tell the landlord, thank you very much. Hopefully I get my full security deposit back and I go on my merry way. That is term life insurance. You build no equity, you have no cash value. It's just for a term. Okay? So there's something called annual renewable term. This means that the term insurance renews every year. And as we discussed on the previous slide, as you get older, the insurance costs more. So annual renewable term insurance will increase every year that you renew it. Okay? Another option is called level term. This means I can lock in my price for a specific time window, typically 5, 10, 20, 30 years. So if I purchase it at, let's say, age 30, I can lock in my life insurance rates from age 30 to 35 and then renew it at age 35, and then I pay that from 35 to 40. So it's locked in, let's say, in those 5-year windows. So insurance products like this are going to be averaged out. So if you choose a 5-year level term, that will be less expensive than a 10-year, right? Because 10-year has to be cost competitive for those entire 10 years. So it's going to be a little bit more expensive than 5-year term, but less expensive than 20-year term or 30-year term, okay? There's also something called group term insurance, which means that it's for a group of people. So kind of like health insurance, how you average it out over a bunch of different people, and the cost to everybody overall becomes more equitable, and it's less expensive for the unhealthy people, but more expensive for the healthy ones. That's kind of how group term is, right? So you kind of average out all the folks and say, okay, everybody pays this one rate, and that's group term. All right. The next genre of insurance after term insurance is permanent. So permanent insurance is for your whole life. So instead of only being active for 5, 10, 15, 20, 30 years, whatever you decide, permanent insurance is from the day you get this policy, it will be in force as long as you pay your premiums until the day you pass away. Okay? So there is no difference in the way that these insurance policies are priced. The cost of insurance is the same no matter what product you get, okay? But the difference between permanent life insurance and term is that permanent is more like buying a house, because the money that you pay towards the insurance, it builds up, let's say, equity over time, which is called cash value. So it's priced just like term insurance, but you also get to build up cash value over time. So it costs a little bit more. So just like, again, back to our apartment example, I may be able to rent a house for maybe a little bit less than I can buy the house, right? Because when I buy the house, I have property taxes, I have property insurance, I have some of these ancillary things that I have to worry about, maybe HOA dues. I have to incur the cost of purchasing appliances. I have to purchase the new roof. I have to pay the landscaping, all these things, right? And so because of that, I build equity over time when I own the home versus when I rent the apartment. So even though buying a house may be more expensive, and we're talking like your personal residence, right? So typically for investment property, it is less expensive to own it because otherwise you wouldn't make any money renting. But in your own personal house, typically that house is going to be a little bit more expensive to own than a 1-bedroom apartment, when you first move to a city. And there's reason for that. As you pay your mortgage, you become more and more of the owner. You own more and more of the house. So therefore, you're able to build what's called equity in the home. So if the house appreciates in value, then you get to keep any difference between what you paid for the house, what it sold for, and the amount that you paid down. So the amount that you paid down is known as equity. So even if the house didn't go up in value at all, you would still, if you sold the house for exactly what you paid for it, it's okay, because you would recuperate all the money that you spent on your mortgage every month. Of course, not with the interest, right? but you would recuperate the amount that you paid down. Same thing with permanent life insurance. You have your term insurance, which is the cost of insurance, the COI that we talked about in the previous slide. And then we have the cash that we're building up over time, right? So we're building up equity in the property, i.e. the life insurance policy. Okay? And just to make things a little more interesting, there are different types of permanent life insurance. They are whole life, universal life, variable universal life, and index universal life. So don't worry about it. We'll be going through each of these individually. And so as you're listening to this, kind of take note as to which one seems best for you and your family situation. Again, knowledge is power, and we just want you to be informed purchasers of your life insurance so that you can know what it is you're buying and can be confident that that is the best solution for you and what your family needs. So permanent life insurance is also called cash value life insurance. Okay, let's go back to the top and talk about term life. All right, so remember, the first type of term life insurance is called annual renewable term. So again, on these charts, we're starting from the left, going to the right, and those are age. So let's say on the left is age 0, and on the right is age 100. Okay, so as you get older, the cost of insurance goes up, but the premium you pay goes up every year in annual renewable term because the cost of insurance goes up every year. You're not locking it in. You're just saying, hey, I'm age 30 today, so I want insurance from age 30 to 31. Boom. All right. When you're age 31, insurance costs a little bit more, so I'm going to get insurance from age 31 to 32, so forth and so on. So the premium that you pay goes up every year because the cost of insurance goes up every year. It's denominated in however old you are at that time. Okay. Next up is level term. So for the purposes of this example, let's talk about 5-year level term. So this is the one where the price will stay the same for every 5 years. So if you look at this, it's like a stair step, okay? So on the left-hand side of this 5-year level term graph, you'll see that a price is set and it holds for kind of like a step. And then at the end of that term, it goes up to the next step. So this is saying, back to our same example, if I start my insurance at age 30, I'm going to lock it in for 5 years, age 30 to 35. Then I turn age 36. My cost of insurance is no longer priced as it was when I was age 30. It's now priced based on a 36-year-old. So I have to pay more. But I can lock it in for 5 more years. So now I'm locked in from 36 to 40, right? Okay? And so forth and so on. So that premium is locked in for that 5-year term. But at the end of that 5 years, the price readjusts, hello, okay? I'm going to adjust because you're older now. And now the cost of insurance is based on however old you are at that time. And so your premium is going to go up in lockstep with that level. Similarly, we can do 10-year level term. So as you can see in this one, the steps are a little bit longer, but so are the increases. The height of my steps are increased, right? Because now, again, if I start my insurance at age 30, and I lock it in for 10 years, so that's age 30, let's say to 39. Now when my cost of insurance is readjusted, I'm now a 40-year-old. So the cost of insurance for a 40-year-old is more than it was for a 30-year-old. So therefore my premium is more expensive because I'm older, okay? So 10-year level term, and it holds that price for a longer amount of time than the 5-year. And of course, because it was level for that 10 years, it costs a little bit more than the 5-year because they have to average it out over that full window. And same thing with 20, okay? So for this one, the premium goes up every 20 years because it's locked in. So essentially, you can lock in your insurance from age 30 to 49. That's 20 years of the same price. You're locked in, you're good to go. So because of that, 20-year or even 30-year, these tend to be the most popular plans because now I can plan my life out. And I know I might be paying a little bit more as a 30-year-old because I'm trying to average out from age 30 to age 49, so that full 20-year period. But in the long run, it's going to be more cost effective because, hey, I'm able to lock in my rate for that whole 20-year or 30-year window. So here, let's look at an example of a typical term insurance policy for a 20-year level term for a 30-year-old client. And this particular person is preferred plus non-smoker. So remember, they are like Olympic athletes, like amazing people. And again, this is purely for illustrative purposes only. You know, again, the premiums that a person has to pay is based on their own health history and things like that. So this particular person, they have a base premium of $250, and with any additional riders they got, their total annual cost of insurance is $258, and they have a 20-year locked-in rate. So from year 1 to year 20, as you can see on the screen, the premiums are locked in at $258. Not bad. But when insurance expires, that term is over, the person is now 50 years old. So they can renew, but now they're 50 years old. So what is the cost of insurance for a 50-year-old person? Same amount of face value. Well, that means it is $4,325 per year. So they went from $258 a year to $4,325 a year. Hey, you're 20 older. It makes sense, right? So hopefully you can see why locking the rate for a longer amount of time is advantageous. It just allows you to plan better, lock in your premiums at a very affordable rate. So looking at that wealth curve, ideally by the time you're 50, you might not need insurance anymore, or the amount of insurance that you're getting for that term policy. So you might not need to pay that $4,000 a year. But hey, what if you don't reach your goals? Then what? You better have that life insurance. All right. So again, their premiums when they started the policy were $258, but after that 20 years, when the term expired and they needed to renew, the premiums increased significantly to over $4,000. All right. Let's compare to a standard non-smoker. So the preferred plus guy was $298. The standard non-smoker, $491. Okay? So there's a difference in just the healthiness of these people. So it's not backbreaking. I mean, $258 a year is pretty inexpensive. So doubling it to just under $500 at $491 isn't awful. But again, at a 20-year term, you're able to lock it in for 20 years. And when that person is age 50, now again, their rates are above $4,300 per year. So that allows you to see the difference between a preferred plus and a standard. So again, the healthier you are, the less expensive your premiums are. Alrighty. So let's look at this example. So in a typical IUL policy, it has a flexible premium adjustable life with an index account option for a 70-year-old male non-tobacco client. Okay, so we're going to talk about this particular guy decided, hey, I'm at age 70, I don't smoke, and they're going to pay a monthly premium of $2,500 for a face value of $500,000. We're going to get into this a little bit more, but the main thing that I wanted to show you is that this person, their life insurance policy, if you look at it, it has the initial face value is $500,000. But if we look over on the right-hand column under non-guaranteed assumptions, you'll see that that death benefit increased over time. So even though they were paying money, their death benefit was able to increase. Okay? And then you'll also see this column called cash surrender value. That's what we were talking about earlier when we say that the life insurance policy bills money in it over time. So in a term policy, remember, you pay your premiums, and when that term is over, they say, thank you very much. It's been nice knowing you. Goodbye. But in this one, this is a type of whole life policy. In that value column, and you can see this under guaranteed assumptions, non-guaranteed midpoint, and non-guaranteed assumptions. Regardless, they all have this value column. That is the cash value. So that is the cash that's accumulating in the policy. We'll talk about more of that as we go on. But just wanted to show you that there's a difference in whole life policies versus term. Okay, so let's go back in. So let's look at our rate classes. So let's say we have a male who is age 30 to age 50, and they want a $500,000 policy. Okay, If he were preferred plus, then in order to have that as a term policy, 20-year term level, it would be $258 per year. So if we extrapolate that out over the 20 years, he's paid $5,000. It's pennies, right? Like, you're going to pay $500,000 for the right to have $500,000. You're paying like 1%. That's amazing. So, of course, if you don't pass away, you don't get to use it. But I tell you, 1% I pay 1% of the face value, in order to have access to all this cash in the event that something happens to me. That's completely worth it. Over the whole 20-year period. Totally worth it, 100%. No reason not to do it, okay? Same thing with a standard non-smoker. So at that point, their rates increase to just about $500 per year, $491, okay? Total pay-in is $9,800. Again, hey, we're like 2% of the cost of the face value to have access to 500 grand. Like, that's awesome. It's essentially like saying, hey, will you give me 2 pennies for the option in case something happens to you for me to give you $1? Yeah, who wouldn't do that? Like, keep my 2 pennies. Like, no big deal. Thank you for having the full dollar available for me in case something happened. I appreciate that. And so forth and so on, right? So the less healthy you are, or if you smoke, it's going to be more expensive. Okay? So you can see the differences in price between a preferred plus, again, Olympic athlete, standard non-smoker, which is going to be most of us, and then a preferred smoker. So this is someone that is healthy. They might work out, but they do smoke. So point of this slide, don't smoke, right? It's just going to cost you more. So the preferred smoker in this age range, their total paid in is $17,000. But hey, at this point, we're still like 4%, less than 4% of the cost of the face value. So even as a smoker, it's still a no-brainer. And again, that $17,000 is over that full 20-year lifespan. Huh. A bargain. 100% bargain all day. All right, now let's look at the end of that 20-year term. Let's say this person, this male, wanted to renew his policy for another 20 years. So he had one policy from age 30 to 50, and at age 50, he's like, I might not be as rich as I thought I was. I definitely need to renew. So let me get term for another 20 years. Okay, again, 500 grand. So if he's a preferred non-smoker, then his costs are about $1,100 a year or $22,000, again, over that full 20-year period. If he was standard non-smoker, 35 grand, okay? And a standard smoker pays just under $5,000 a year or just $97,000 over the course of the full 20-year period. So even worst case scenario, you wait to age 50, okay, and you're a smoker. Over 20 years, you're paying 100 grand, just for argument's sake, to have access to 500 grand. It's kind of like an option fee, if you've ever heard of that, like in the stock market. You're paying to have the option to exercise this option at a later, So you're saying, hey, I'm willing to pay 1/5 in order to have the full 500 grand. I'm willing to pay 1/5 of the cost of this so that I can have access to this money. So if you don't want to pay a premium, get life insurance young and be healthy and don't smoke. But by all means, term life insurance is 100% a bargain. So over the course of a total of 40 years, so again, 2 term policies, first they were preferred plus, then they become preferred non-smoker. They started having a little pot belly or whatever. No biggie. The total paid in for that entire 40-year period for the healthy person is $27,780. Can somebody say bargain? Just saying. Awesome. Standard non-smoker, 45 grand. Again, you're like 10% over 40 years. Who's gonna hang out with you 40 years and you only pay me 10% of what I'm holding on to on your behalf? Brilliant. Okay? So if we were to convert from, I'm getting excited. Whew, let me relax. So let's say at age 70, the guy is still here. He's still kicking. Oh, so at this point, he wants to convert it to one of those whole life policies. Okay, like, you know what? Before 70, I should probably just like stop playing roulette and get a whole life policy at this point. All right. So he now wants to convert his term policy to a whole life policy. And this particular kind is called an IUL, Index Universal Life. And again, we'll chat more about that in a couple of few slides ahead. So if he wanted to convert that policy from term to a whole life policy, it will be about $2,500 a month or $30,000 a year. Okay? All right. So what are the advantages of a term? There are some. It is cost effective. No bones about it. So you have this low net cost, which means it's really affordable for you. Right? So if you're under 50, it's great. It's a great option. Okay, it is really cost effective. It gets the job done. No harm, no foul. Okay, but and it's really the best bet if you only want it for 20 years or less, and you can't afford a plan that builds cash value. That has like that equity build. Because after 20 years, like the costs are going to be so expensive that you probably should have considered getting a whole life policy anyway. All the things that you're quote unquote saving, it's going to cost so much more because you're now 20 years older that it's going to be very expensive. So, hey, if you're young and you're like, yo, I just need something in place, perfect. Go turn all the way. But do keep in mind that if you're going to need life insurance for more than 20 years, if you're planning to live more than 20 years, then you might want to consider one of those whole life options, which we'll get into and discuss in more detail so you can determine for yourself how that fits into your strategy. The term, all right? It might be cheap as chips, but who renew in that 10 or 20 years, after that first term is complete? And who knows what shape you're going to be in? You might not be as healthy anymore, right? So you run the risk of being uninsurable at any point in that 10 or 20 year cycle. Let's say you have a change. You might not qualify for that preferred rate anymore. Hello? Or in this scenario we just talked about, our coverage runs out at age 72. So some term policies will say, yeah, I'll renew you, but only until age 72. I'm not going to do it anymore. So what are you going to do then? You're up a creek without a paddle. Not so good. Okay. And hey, if you miss any premiums, the coverage will lapse. There's no backup. Either pay up or get out, right? So it's like renting. You pay to stay. So if you don't pay your money, the policy lapses and you have to start all over again. And remember, you're now older, might be a little pudgier. You just might not be as healthy, right? So it's something to keep in mind. If you miss paying a premium, the whole thing blows up and you got to start all over again. A few more disadvantages of term insurance is that your future renewal rates, they could be potentially very high, especially if you have a 20 or a 30-year term. At the time of renewal, you are 20 or 30 years older. And again, if your policy lapses or is not renewed, then the premium you paid is wasted. You have no return on your premium if you don't die. I mean, like, wait a minute, you don't really want to die, right? But if you didn't die and you paid, let's say, that $27,000 over 40 years, it was just an option fee. So the insurance company is going to say, thank you very much. Congratulations on not dying. Have a good rest of your life, right? So, hey, it was a bargain. Like, you didn't even pay 10% of the cost of it. So you can't really be mad. But, hey, that was $27,000. And you have, practically speaking, you have nothing to show for it, right? So it just kind of depends on how that lands on you. But who really wins when you've paid this premium for 40 years and they're like, thank you very much. Have a good day. I personally don't like that. Because the insurance company wins. All right. Group term insurance is typically what is offered through an employer for employees. So if you have life insurance through your job, group term insurance is most likely what you have. Okay? The benefit is typically somewhere in the 1 to 3 times your salary range. And of course, you can go higher if you so choose. But typically, just the base package is 1 to 3 times your salary. Okay? You don't need to qualify. It doesn't matter what your health condition is, and it is cheap as chips. Again, it's kind of like health insurance. We're just going to mix you all up in a pot. And if you're healthy, yeah, you might pay a little bit more. If you're unhealthy, hey, you got cheap insurance. So if your job offers you life insurance, hey, take it. Hey, it's cheap. But it does typically terminate when you leave employment. Now, some companies do have the option for you to take that life insurance with you because it was locked in seemingly at that lower rate. You were at a younger age. But hey, because you're no longer in the group, you're not taking a group policy out of the group, so your premiums will be more expensive if that happens. Okay? I've seen group term policies where the premium increased 3 to 4 times based on the fact you're no longer in the group. And I can speak from my own personal experience, and in my employer, it was like $8 a month for insurance. And when we costed out how much it would be to take that policy, poured it outside of the company, it was going to be $68 a month, which is more than 3 times. It's like a lot of money. It's not a lot of money, but considering it was $8, I'm just saying, it's crazy. So at $68 a month, you have to start thinking, is term really the best option for me? I might be able to do something better with those funds, right? You may have heard of accidental death and dismemberment. So these policies, they are very inexpensive, but they are not a good value. Why is that? Because most people don't die by accident. Most people die by health concerns, not getting hit by a car or like a freak bee sting or something like that. So these policies only pay out if you die by accident or if you're dismembered. Dismembered means like your arm or finger or something like that gets cut off and you are dismembered. So again, most people don't die like that. So while they may sound good because they're so inexpensive, they're typically not a good value. Okay, so let's review a couple of questions. Should you buy life insurance with the rest of your life in mind? Absolutely. Also, how long do you think you will live? A good exercise is to think about some of your closest loved ones, like if you have any elders. So think about grandparents, parents, aunts, uncles. How long did they live? And then, ask yourself, are you healthier or less healthy than they are? So if all your aunts and uncles and parents and everyone has lived well into their 80s and, you are even healthier than they are, okay, you might be around here for a little bit. Or if everyone in your family passes away in their 40s, from a massive heart attack, and you haven't made any lifestyle changes in order to do better, okay, hey, term might be good for you. Then you can hedge your bets. But that's a good way to determine how what type of life insurance policy is best for you. And of course, no one can tell the future, but life expectancy of our family members is typically a decent enough barometer because our eating habits, our lifestyle habits, how much we exercise or don't, is typically going to be influenced by those people that are older than us or who we grew up with. Also, do you want or need insurance in your senior or retirement years? Again, this is a personal question. Are you wanting to leave behind more money or more funds than you've been able to accumulate in your own personal lifespan? If the answer is yes, then you might want to consider life insurance even into those senior or retirement years. If the answer is no, then maybe not. But one thing to consider is everyone still needs enough money for their final expenses. So final expenses are those burial costs. So literally the cost for a funeral or a cremation, preparing the body, removing it from the hospital or whatever. So not to be morbid, but even if you choose to go the inexpensive route of cremation, there are still costs associated with that, and somebody has to pay, typically within 1 to 2 weeks after passing. And so if you don't have enough money to do that, and you don't want to burden other people with those expenses, then final expense insurance is a good option for that. because that's its entire purpose, is to pay for final expenses. If you do have sizable assets, then you may be subject to estate tax. And one thing that wealthy people use is they use life insurance to pay estate taxes. So let's say you have a $10 million estate, and above $5 million, an estate tax is due of 10%, just to throw out numbers, okay? So if I have a $10 million estate, 10% is $1 million. Just because you have $10 million in assets doesn't mean you have $10 million or $1 million sitting in the bank that you want to pay to the government, right? So life insurance can also be a strategic way to pay any estate taxes. Alrighty. So now we've talked about why you need life insurance, and we've covered term life insurance. Annual renewable term, 5-year, 10-year, all the different levels of term insurance. Now let's talk about the other type of life insurance called cash value or whole life insurance. Okay? So whole life insurance is exactly what it sounds. It's for your whole life. Okay? And remember, there are different types of cash value life insurance. The first one, even though they're all for your whole life, the first one we're going to discuss is literally called whole life insurance. Okay. So whole life insurance has what we call a fixed premium. So if you remember when we were discussing the term insurance, how over that 20-year term, the price is averaged out for that entire lifespan, that entire time period. So for example, a 20-year term would be more expensive than a 10-year term. Similarly, a whole life insurance policy would be more expensive, particularly in younger years, than a term policy, than other policies, purely because we are averaging out over term policy, because term is only for that 10 or 20-year period, but a whole life is averaging out for your whole life. So therefore, if I'm trying to make sure I can pay one amount of money for my entire life, then I'm going to have to pay a little bit more while I'm young and essentially pay a lesser amount, a discount, when I get older. But here's the trick to this, or what, not a trick. This is what makes this brilliant. Remember we talked about how the cost of insurance, no matter if it's term or a cash value policy or a whole life policy, the cost of insurance is the same. The cost to insure a 30-year-old is the same no matter what kind of policy it is, right? So what that begs the question, what happens to the rest of the money in these whole life policies when, I can insure my year 30 to 31 for $250 for a year. Why am I going to pay more for a whole life policy? Well, the money doesn't go away. It just goes into what we call a cash value account. So think of it like I'm storing up for winter. So I'm going to pay a little bit more in the beginning when I'm younger, so that when I'm older, I have this store of reserves that I can draw from. That way I can pay just that fixed premium for my entire lifespan. So if you look at the image on the right, this displays it very well. So that cost of insurance, the COI, is the same as it was in the annual renewable term, right? The cost of insurance stays the same no matter what kind of insurance we have. But for a whole life policy, my premiums, the fee I have to pay in order to put this insurance in place, costs more than my cost of insurance. So I have this gap left over, this little bucket of money called cash value. And then when I get older, past a certain threshold, then that cash value is used to pay the cost of insurance in my older years. Okay? So whole life insurance has a fixed level premium for life. Okay? And the beautiful part is that you can actually access this cash value for use today. And the way you access it is from a policy loan. Now, this may sound weird that you're getting a loan for money that you put into this insurance policy. It's like, what? But no, think about it. It's like having a savings account, and I get to take a loan from myself. So imagine you have money in a savings account at Chase or Fidelity or whatever, and when you want to buy something, instead of you having to withdraw all the funds to make that purchase. Instead, you take a loan against your own money, and the money still stays in the account. So what that means is the money still grows as if the whole amount was in there. And when you pay the money back, you're paying yourself that premium plus the interest rate. Awesome sauce. All right, cool. The policy loan typically has a low guaranteed interest rate. Okay? And sometimes these whole life policies also pay a dividend. Now, it's not guaranteed, but that dividend can be used in a variety of ways. So you can use it to lower your premium, you can buy additional insurance, or you can add to your cash value. So you can take these dividend payments, just like a stock, how stock pays dividends. Your life insurance policy can pay dividends also. And it's up to you what you do with the money. So you can say, hey, I don't want to send in as much money this year, so you can just apply these dividends to my annual payment or my monthly payment. Or you can say, hey, I'm going to pay what I normally do, but since I have more money available, how about you buy me more insurance, increase my death benefit. Or you could say, nope, just put in my bucket of money. I don't want any more insurance, but I want to have more in my savings bucket. And that means you're adding it to your cash value. All right. And this particular type, whole life policies, this is the least flexible of all permanent life insurance options. Okay? So we're going to discuss all the different permanent life insurance options, but the kind that's called literally whole life insurance is the least flexible of all. All right. So here's an example to talk about alternatives to cash value. So how it works. So on the left column, the far left column, you'll see the end of policy year. Okay? So let's say 1 is the first year you get the policy all the way to year 20, and then down when you're age 60 and 65. Okay? Now, this savings account builds up over time. But like a lot of stuff, it has a bit of a slow start because, A, you're still buying insurance, so you have to pay for the insurance, right? The cash value column, so column number 2, that is the savings account column. So what you'll see is you're paying your premiums, okay? But by year 3, even though your cost of insurance is low, remember, so that bucket of money starts to grow. And so by end of year 3, a portion of your payments go towards this cash value. So at the end of year 3, you have $200. At the end of year 4, you have $1,000. In year 5, you have $800, right? It's amazing. So this cash value increases every year. So remember, in term policies, you're paying your premiums, but you don't get any of your money back, so to speak. In the event of a whole life or a permanent life insurance product, you are able to build up the value of the cash. So essentially, you get to have a savings account type. Cash value is not exactly a savings account, but it's similar to a savings account, and it builds up this value over time. So you can see where your premiums are going. It's not just going into like this, empty wasteland, which is awesome. All right, cool. So let's talk more about the second type of permanent life insurance called universal. So universal life differs from whole life in that you have a flexible premium. What does that mean? That means, in case if you have an expensive year, you could say, hey, I just can't pay as much as I would like to, or, because I had a rough year. Or if you had a really good year, you can almost like pay it up, so to speak. So it gives you some flexibility as to what you pay every year. So you're not locked in to saying, hey, you have to pay $1,000 every year, no matter what, like the whole life, which is why they call it the least flexible. So using the same example for universal, you could say, hey, I'm going to pay my $1,000. But year 2, kind of a rough year. I'm only going to pay $500. But year 3, I can kind of make up for what I didn't pay in year 2, so I can put in $1,500, and so forth and so on. So it gives you flexibility. Now, that flexibility is not to be abused because in order for the policy to work as intended, you do need to pay the intended premium amount so that it can be what we call fully funded. Okay, so that's something to keep in mind. So the flexibility is great, but it is not to be abused. So here's the thing. Throughout life, 4 things are going to happen. You're going to have a financial emergency. You're going to have a financial opportunity. You're going to stop working. And you're going to kick the bucket. You're going to pass away. Okay? So what universal life does, it allows you to fluctuate your premiums in response to those opportunities. So let's keep talking about this one. So let's say you have 100, 200, 300 bucks a month. What are your options? What do you do with it? You can put it in a bank. And okay, that's a decent option, right? It's safe, it's liquid, I have a guaranteed interest rate, but typically my yield is pretty low. But hey, I understand how a bank works. All right, cool. I can put my $100 to $300 a month in investments. That means it has an opportunity for growth. I hopefully can outpace inflation. I have ownership. And, I might be taking a little bit of risk though. All right. Let's say I put $100 to $300 a month in additional premium to my life insurance policy. How does that work out? So let's say, again, we're going back to that $500,000 face value on our life insurance. What that would do is it allows us to build cash value. So in this bucket, you see this little spigot on the side? That's the policy cost. Because again, at the end of the day, this is an insurance policy and we still have to pay our cost of insurance. Because hey, the purpose of life insurance is to generate cash, not to do anything else. It's to generate cash in the event of someone's passing, period. The fact that you can build cash value just makes it that much more awesome, attractive, interesting, cool, all those things, right? Okay, cool. So this bucket of cash value is here. And so essentially, I can put my premium in a life insurance policy and allow this cash value bucket to grow. And I can allow it to grow bigger and faster than my cost of insurance, particularly when I'm younger and my cost of insurance is low. All right? So here's what happens. These policies have a guarantee. That guarantee is typically about 3%. Okay? And that is the guarantee policy like this is called regular universal life. Okay? Now let's say I want to supercharge this cash value and I want to put it in the market. Okay? So it's in my life insurance policy, but I'm going to take this cash value and put it in the stock market. That type of product is called a variable universal life insurance policy. And it's in the stock market. So your return can go up and it can go down. You can make money or you could lose money. You don't know because it's in the market, but you have the option to be in the market, which in and of itself is pretty cool. Okay? Then there's kind of the mid-grade option called index. Index says, if you've ever heard of the S&P 500, those are indexes. And the way the S&P 500 works is it's like a summary of the biggest companies, and they are all together in one mutual fund, right? This index. And so you get paid out the average of how all these individual companies perform. Similarly, in an index universal life insurance product, you have the option to put your cash value in an index. So it has a floor and a cap. So it's kind of like Goldilocks, not too big, not too small, just right in the middle. Index universal life is kind of like that. So you have a floor, which is a guarantee. And so its floor is 0.75%. Depending on the product, again, this is purely for illustrative purposes only. And its peak can be up to 15%. So the guarantee floor is not as high as the 100% guarantee, like regular universal life, right? And it has a cap on it. So obviously, if you're in the stock market, you can have infinite return, 20, 30, whatever percent. So index is kind of a middle ground where, you know what, I'd rather have a floor and a ceiling, and my floor is still guaranteed. It's not as high as if I was just in the guarantee, but I'm able to earn more. But in exchange for that safety and security, I'm willing to cap it out. I'm willing to agree to a cap of only 15%. Okay? So those are the 3 different types of universal life. Again, we have regular, index, and variable. So let's talk about the features and benefits of these universal life products. So one thing that you can do is you can increase or decrease your insurance amount. So even if you start out with $500,000 in face value, over time you can increase or decrease that amount based on your needs. That gives you additional flexibility, which is great. So why would you want to decrease the face value? Well, the less death benefit you buy, the less expensive the premium is, which means it's less expensive. So if you hit on hard times, you can say, you know what, I don't want to pay as much. I'm just going to reduce my death benefit over time. Or, hey, you can say, you know what, things are going well. I want to leave even more for my family. Or I need to make sure that I have even more available for them so I can increase it over time. So again, it's very flexible in that way. Additionally, you can design the policy so it pays the face amount upon your passing, right? Which is level. Or you can say, hey, I want you to pay out both my face amount plus my cash value. And that is what we call increasing. So it's up to you how you want it to pay out, either level or increasing. And you can vary your premium payments. So you can skip premium payments. And depending on how it's all done, you may even stop payments after a time. You know, again, if you've paid the policy to a portion where the cash value, that bucket, is large enough, you might not even need to pay premiums anymore. It's really nice. Additionally, you can even add multiple insured people. So you can have more than one person on the product. And just to make these even more just like interesting, cool, and awesome, you can add what we call a long-term care benefit. Now, remember how it did, how the cash value took a couple of years to begin increasing cash, to begin building cash value? Well, these policies are not for people that are wishy-washy. If you get one of these, you need to be in it for the long haul, 10 years plus, okay? And the reason why that is because in order for the policy to work its best, it needs to be in place for that long. And so insurance companies have what we call penalty charges. Essentially, they're guardrails to make sure that you understand this is not like a fly-by-night type of product. It's really for people that want to have it for the long term. So they have a penalty essentially for you wasting their time, is the way I would describe it. So if you cancel the policy somewhere in the first 7 to 15 years, and it depends on the product and it depends on the company, then they will have what we call an early surrender charge. Now, those charges decrease the longer you have it. So let's say, hey, you change your mind in year 6, that's okay. But your surrender charge, that penalty, will be less than if you canceled it in year 1. So just something to keep in mind. We're all about eyes wide open here. So let's summarize the features and benefits of a universal life plan versus a whole life plan. And again, both of these are permanent life insurance policy options. So on the universal life, you have a couple of costs. You have a state premium tax, you have a policy fee, cost of insurance, mortality expense, and again, the cost of insurance, that unit per 1,000. All these policies costs are broken down and are shown in the policies and ledgers. So if you're a person that wants a lot of transparency and want to know exactly how much insurance costs, that will be something you may like in a universal life product. A whole life policy provides fixed or guaranteed values. So what this means is they're not going to show you all under the hood. They'll just say, hey, this is what I'm paying you, and I promise no matter what, this is what I'm going to pay you. And because those values are guaranteed, which, hey, has its own advantages, right? They're not required to disclose the actual policy costs and charges. So what does that mean? Hey, if I promise you I'm going to pay you 4%, but I'm able to make 8%, that's none of your business. I'm going to keep that as arbitrage, but I promise you I pay this amount and I'm going to pay that amount. So that's how whole life policies work. So some people really like the guarantees. Like, I want to know that I know that I know that at age 73, I'm going to have X amount of dollars in cash value and X amount of dollars in death benefit if I pay my premium. Nothing wrong with that, right? But you most likely won't get that same disclosure of all the costs associated with it. So just something to keep in mind. Again, we're here about empowering you to make your own decision. There are no right or wrong answers here. It's really about making sure that your family is protected in the best, most secure way possible. So let's talk about the tax advantages of cash value life insurance. So term insurance did not build cash value, so there were no tax advantages to speak of. But specifically in the form of a permanent life insurance product that builds cash value, there are some tax advantages that we'd like to highlight. The first one is that the death benefit is tax-free. Now, this does apply to all life insurance, not just cash value, right? But the death benefit is tax-free. Awesome. On that cash value in a permanent life insurance product, the earnings, so again, they are returning, you're getting an earning. So either that guaranteed amount, the index that had a floor and a ceiling, or the variable amount, no matter what, those earnings on that cash value, they earn money tax deferred. So they get to grow without being taxed in the meantime. That's great. And then you can withdraw the money tax free. Why? Because again, we're checking it out as a loan. You don't pay taxes on a loan. Huh? Brilliant. Legitimately brilliant. This is like awesome. Okay. Because again, loans are tax-free. So if you want to take a withdrawal, you can. You can withdraw that money tax-free, or you can take a loan against it, which is also tax-free. Just wanted to clarify that. Okay. So let's talk about the 10-20 formula. So this is a simple rule that can calculate what you need. So again, if you die too soon, like prematurely, you'll need 10 times your income to protect your family. Okay? But let's say you live too long. You're going to need 20 times your income for your retirement. So let's put this in perspective. Let's say you earn $50,000 per year. If you pass away prematurely, you're going to need $500,000 in protection for your family. That way they can go on living with that same value for the next 10 years. But when it comes time to retire, you're going to need $1 million. 100%, you're going to need $1 million. The whole purpose of this is to show you what you need. And you need to know what it is that you need so you can have your eyes wide open. And the beautiful part about one of those permanent life insurance policies is that it can help you solve both of these concerns with one product, which is helpful. So really, it's about managed growth and winning the money game. So when you're making financial decisions, you want to ask a couple questions, right? Can this amount of money potentially grow to achieve my goal? Yes or no? Is it safe enough, right? Like, okay, I can grow it, but like, am I risking it all for that growth? Does it have any tax advantages? Because I tell you, the highest expense most people have is taxes. And then does it have the proper protection in place? So you can build a strong financial foundation, and it's just important to make sure that you're addressing all of these concerns as you're going out and trying to put something in place for your family and for your own future. So, hey, which one did you choose? We got the cost of insurance, right? We have term, which is inexpensive and only for a certain amount of time. We have traditionally whole life, which does build cash value. So out of the permanent life insurance options, we have traditional whole life. It does build cash value, but those premium amounts are fixed. We have universal life, which also builds cash value, but the premium amounts that we pay are flexible. And then we have indexed universal life, who also builds cash value. The premium amounts are flexible, and the money in the cash value account is in an index, so it has a floor and a ceiling. All right, so let's just wanted to dive in a little bit more on that cap and floor, just so it was a little more clear. So let's talk about the strategy concept. So, for example, let's say that we have one of these indexed permanent life insurance policies. We call the Index Universal Life. And based on the market index, it has a 13% cap and a 0% floor. So that means that the money in my cash value account will only get a maximum of 13%, but I'll never lose any money because it has a floor of 0. So no matter what, I won't lose any money. Okay? So let's go through it. So here's an example. I have $100 in my cash value. And in example number 1, I have no cap and no floor. Okay? So in year 1, the market goes up 18%. If I start with $100, I have 118 bucks. Awesome. Hashtag winning. Let's say year 2, though, the market isn't doing so hot, so I lose 15%. So if I lose 15% on 118, now I'm at $100.30. The market goes up 10% a year. In year 3, I'm back to 110. Awesome. And let's say this time in year 4, the market goes down by 5%. So I'm at 104.81. Okay? So I've gone up 18, down 15, up 10, down 5. All right? Let's talk about example number 2. So in this example, I have a 13% cap, but a 0% floor. All right? So in year 1, the return was 18%. Again, I have a 13% cap. So I don't, that additional 5%, it goes to the insurance company. Okay, so I only get 113. In year 2, the market goes down 15%. But remember, my floor is 0, so I hold steady at 113. Year 3 goes up by 10%. Woohoo! Year 4, again, was a rough one, so I have a 0% floor, so I hold steady at 124.3. Which one won? Okay? So sometimes it sounds bad to have a cap on your earnings, or something like that. Say, no, I want to swing for the fences. But sometimes having that safety net on the bottom can actually do a lot of good for us. All right. So let's talk about just a summary of the life insurance options. So we have term. So these columns, the first column is talking about the different features of these products. And each column talks about a different type of policy. So the first column is term, again, which is a fixed period of time. The second column is whole life. So that is the one with the fixed premiums. Universal life is in the third column. So it has some flexibility in the amount of premiums that we pay. But it does build cash value, just like the whole life. Indexed universal life. Because it's universal life, you have a flexibility in your premiums. But that cash value goes into an index as opposed to just being paid a flat interest rate. And then finally, on the far end, we have variable. So again, it's universal life, so you have a flexibility in the premiums you pay. And the cash value is in the stock market, so it's variable, right? So it can go up and down. And just for clarity, in either of these cases, the cash value is never actually in the stock market or in the index. It is just pegged to the stock market or pegged to the index. So I just want to clarify that. All right. So what does term insurance give you? It gives you a tax-free death benefit and a fixed premium. Again, it's very inexpensive. Awesome. Whole life insurance, however, does also give you that tax-free death benefit and fixed premium, but it also allows you, through cash value, access to your money. So you get access to some of those premiums that you've paid through the cash value. Because whole life is fixed, it gives you a guaranteed minimum interest rate. It has the option to exceed that interest rate, but you do have a guaranteed minimum. So it gives you some safety and security. Feels nice. That cash value gets to grow tax deferred. And again, you can take loans against that cash value tax-free. Universal life also gives you that tax-free death benefit, access through your money through cash value. But instead of a fixed premium that you have to pay, you have a little more flexibility. Again, it gives you that guaranteed minimum interest rate. You're able, to withdraw the money, the money grows tax deferred in the cash value account, and you can get loans from it tax free. Universal life also differs from whole life in that you can withdraw your cash value tax free as well. In terms of index universal life, it hits the highlights of the other one. So we have tax-free death benefit, access to your money, that flexible premium. You still get that guaranteed interest rate, albeit might be a little bit lower than in whole life or universal. The money in the cash value still grows tax deferred. You can access the money through tax-free loans, and you can withdraw it. But it also has a cap on your interest rate and a minimum floor. And then finally, variable universal life insurance has that tax-free death benefit, access to your money, flexible premium, but your cash value is now participating in the market. So you're credited towards market participation. Other benefits, you have tax-deferred growth, those tax-free loans, and again, you can withdraw those funds in the cash value account tax-free. A good summary there for you. All right. I do want to take a moment to discuss final expense insurance. Some of you might be saying, this is all wonderful and fancy and wow, I love all these things. But I would like to get life insurance for a loved one, right? So they might not be financially in the place where they can contribute an additional $2, $3, $100 or more per month or, annually for one of these super, arbitrage life insurance policies. But I don't want to get stuck with a bill, in the event of their passing. That is what final expense insurance is for, okay? And there's no rule that says you can only have one type of life insurance. To be honest, we have multiple types of life insurance. We have final expense and IUL as well as term. So we like to, depending on what you're trying to do, there may be room for all of these different types of insurance products in your financial plan, right? It just depends on where you're going and how you're getting there. And so we don't bash any particular genre. It's all about you being informed so that you can make the right decision for you and your family, okay? So again, let's talk about final expense. So final expense is for small coverages, usually for final expenses. It can be very helpful for people with health issues that don't qualify for quote-unquote regular life insurance. It's easy to apply for, and usually it doesn't require a medical test. And depending on the specific final expense product you select, it may even have some ancillary benefits. So it might not be tax advantaged, but it can give you some other stuff, like a concierge service. What is that? So it can help you with the funeral planning, negotiating prices, handling other burdens during those difficult times, which, as a person that has experienced that firsthand, it would have been really nice to be able to call a concierge, kind of like when you're on vacation and you go down to the concierge at the front desk at a hotel and ask for restaurant recommendations. This is kind of like that, right? So it would have been really great to be able to pick up the phone and say, hey, this just happened. Can you help me price out the best, funeral home or a place to get flowers or some of those other ancillary items that are needed. And you're already stressed and tired as it is. So to have that benefit is really great. Really and truly, final expense is good peace of mind for family. So it's not necessarily swinging for the fences, it's making sure you should cover your bases. There are a lot of choices out there. If you haven't already signed up for your complimentary financial needs assessment through Housing JV, do let us know. We'd love to sit down with you. We have access to a variety of financial product providers. We're not biased to any one company. So we are very happy to help you and would be more than willing to sit down and help you make the best decision for yourself and even go the next step and help you put these items in place should that be the option that you want. So in summary, let's talk about term versus permanent insurance and which one is best for you. Here are the advantages of each. When we're talking about term insurance, okay, it has a low cost initially, which is great. However, not only does it not build cash value, but the cost does go up at the end of that term, if you're even able to renew at all. Again, you build no equity, so you have no cash value, and the coverage ends at the end of that term. This type of insurance is really best if you only need it for a short period of time, right? 20 years, 10 years, 30 years, something like that. If you think that you're going to want to have life insurance in place for a longer period of time, then that's really where permanent insurance comes into play. Okay? There's a concept, out in financial sectors that you can buy term and invest the difference. But if you do that, do you have enough investment at the end of that term so that you don't have a need for insurance? That's a risk, right? So at the end of that 20 years, if your investments don't work out, or if you didn't put enough in that investing, in that quote unquote investing the difference, You might be up a creek without a paddle. So a lot of people just buy term, period, and don't invest the difference. So if you're going to do that, then please do be diligent to make sure that you're investing in subsequent in quantities large enough so that you can have the nest egg that is needed either at retirement age or at the end of life. Okay? Going to the permanent policy options now. You can have that variable universal life. Again, you have this bucket of cash value, and you have this spigot on the side that takes out the policy costs. So when we talk about variable universal life, this is really for people that want to accept a little more risk. Okay, these policies were quite popular in the 1980s. It has the insurance potential for life. Okay, it has the potential for growth because, again, that sub account, that cash value account, is in the market. Okay, if we compare this to an IUL, which is the index universal life. Okay, so again, you have this bucket of money, this cash value that's able to grow, and you have this spigot of policy costs that are coming out. As with all of these permanent life insurance options, you're going to have a higher initial cash outlay. It makes sense. You're going to have to fund that bucket. So there's no bucket if you don't have an outlay. But this one has the advantage of having a flexible premium, and there's no renewal needed because it is a permanent insurance product. So it is in place for your entire life. It does build equity over time, and it has the potential to have insurance for life. And again, we have to say potential because since you do have that flexible premium, you do have to pay enough premiums in order to make sure it is in place for life. Okay? So you can't say, oh, I'm just going to pay a little bit and then wonder why it doesn't work out. These types of products are best for someone that has a long-term perspective. They want safety and growth. They kind of want the best of both worlds. So, hey, here's our homework. Complete the remaining exercises in this chapter if you do have a copy of the workbook. Again, if you haven't sat down with us and went through a financial needs assessment, we'd be happy to do that to help you determine what your insurance needs are for your family and for your life. So definitely be something we're happy to do. If you have a copy of the Saving Your Future book, have a look at pages 23 to 48. And again, hopefully you find this information valuable, and we would love to be referred to 3 to 5 people that you'd like to refer to Housing Joint Venture for not only this information, but also the additional information that we have about real estate investing as well. So, money is good for fun, money is good to invest, and money is definitely good to give.